right, welcome. If everybody could take their seats, we're about ready to start. All right. There are too many important people for me to tell you to sit down, but please sit down. Welcome to Chicago. I'm Charlie Evans, President and CEO of the Chicago Fed. We're very happy to be hosting this important conference on monetary policy strategy, tools, and communications practices, and glad that you could all join us today. Vice Chair Clarida and his team have organized an exciting program for us. Our academic colleagues have written a great collection of papers, and I'm sure the panel discussions will generate a very interesting dialogue between academics, community leaders, and policymakers. I'm really looking forward to our discussions over the next 2 days. I first want to acknowledge the outstanding work of everyone who has contributed to putting this conference together. This really has been an outstanding team effort. I only have time this morning to mention a couple of people. I particularly want to recognize Ellen Mead at the Board of Governors for all her hard work spearheading the conference. And here in Chicago, I'd like to give a special thanks to Tiffany Butler and Sarah Day for their outstanding job in handling what has been a tremendous set of logistical challenges, especially to bring the live stream to viewers everywhere. Like many in the audience, something attracted me to the economics profession early on was the way economics uses critical analytical thinking to address important public policy questions. Central banks around the world use economic research and analysis to inform and discipline our policymaking options. If we are smart and humble, we know we can't produce all the right answers. Still, economists, public policy analysts, and policymakers recognize the importance of bringing our best thinking to bear in the decision-making process. This conference certainly exemplifies these kinds of efforts. Now, it is one thing to assess the data, pore over many analyses, and make sensible decisions. But a central bank's work is never done without explaining its actions to the public that we serve. Clear and transparent communication of our policy goals and our decision-making rationale is important for establishing and maintaining the credibility of monetary policy. As we will discuss a good deal over the next couple of days, credible commitment is a crucial ingredient for the success of any monetary policy strategy, and indeed the linchpin for some of the alternative strategies under consideration today. Transparent communications also reinforce the legitimacy of an independent central bank in a democratic society. We have the obligation to inform democratically elected officials, their staffs, and the public about how we expect to achieve our policy mandates. This reinforces that the Federal Reserve is accountable for how its efforts work out. So it is quite fitting that this conference includes panels about what our employment mandate looks like in the communities that we serve. And it is appropriate that our discussions go beyond the usual headline macroeconomic analysis to also consider how monetary policy actions are transmitted through individual households and businesses to the broader economy. I've been at the Federal Reserve for 28 years, and I can attest to the fact that our FOMC communications have not always been crystal clear. And Greenspan famously joked in 1987, "If I seem unduly clear to you, you must have misunderstood what I said." But the jokes aside, during his long tenure as chairman, Alan Greenspan acknowledged the importance of explaining Federal Reserve actions, and he spoke a good deal about them in many public forums. Several important communications innovations occurred during Greenspan's leadership, and further substantial improvements were made under the leadership of Ben Bernanke, Janet Yellen, and now Chair Jay Powell. A very important landmark was in January 2012, when the Federal Open Market Committee published a long-run policy strategy statement. This document formally stated our intention to pursue a balanced approach to achieving our dual mandate objectives of maximum employment and price stability. Our inflation objective was explicitly defined to be 2% annual inflation as measured by the price index for total personal consumption expenditures. One of my most gratifying experiences as Chicago Fed president was serving with Charlie Plosser, Sarah Raskin, and Janet Yellen on the FOMC Communications Subcommittee that developed this strategy statement and other innovations, notably adding interest rate projections to the summary of economic projections. And of course, communications subcommittees after ours worked on many important improvements, such as clarifying that our inflation objective is symmetric around 2%. As important as the strategy document and enhanced SEP are, there's more work to do. The Fed and other central banks have experienced the constraints on conventional monetary policy posed by the zero lower bound, and the reality is that we now live in a world where the odds of revisiting the ZLB are too high. This requires fundamental review and reassessment of our monetary policy framework and strategy. This is a challenging and exciting endeavor. The excellent papers prepared for this conference, the panel discussions, and our Fed Listen sessions throughout the United States promise to be critical and foundational elements for our FOMC discussions. So it's now my pleasure to introduce Chair Jay Powell. As you all know, following a distinguished career that spanned the private, public, and nonprofit sectors, Jay joined the Federal Reserve as a governor in May of 2012, and then became chair in February 2018. Interestingly, Jay has spent one half of his Fed career with policy rates at the zero lower bound. So he is well attuned to the challenges the ZLB raises for reaching our policy objectives and the paramount importance of facing the issue head on. Jay was the driving force behind this reassessment of our monetary policy strategy, tools, and communications. Of course, Jay has not waited for the outcome of this review to take action. Notably, he's been a champion of enhancing our communications. The Fed chair now holds press conferences after every FOMC meeting, and Jay is moving us forward on the Fed Listens project, which includes this conference as well as community forums at all 12 of the regional Federal Reserve banks. So welcome to Chicago, Jay. We're very glad to have you here, and the floor is yours.
Thanks very much, Charlie, and good morning, everyone. I'm very pleased to welcome you here today. This conference is part of a first-ever public review by the Federal Open Market Committee of our monetary policy strategy, tools, and communications. We have a distinguished group of experts from academics and other walks of life here to share perspectives on how monetary policy can best serve the public. I'd first like to say a word about recent developments involving trade negotiations and other matters. We do not know how or when these issues will be resolved. We are closely monitoring the implications of these developments for the U.S. economic outlook, and, as always, we will act as appropriate to sustain the expansion with a strong labor market and inflation near our symmetric 2% objective. My comments today, like this conference, will focus on longer-run issues that will remain even as the issues of the moment evolve. While central banks face a challenging environment today, these challenges are not entirely new. In fact, in 1999, the Federal Reserve System hosted a conference titled Monetary Policy in a Low Inflation Environment, and I know some of you were at that conference as well 20 years ago. Conference participants discussed new challenges that were emerging after the then recent victory over the great inflation. They focused on many questions posed by low inflation, and in particular, on what unconventional tools a central bank might use to support the economy if rates fell to what we now call the effective lower bound, or the ELB, or the lower bound. Even though the Bank of Japan was grappling with the lower bound as the conference met, the issue seemed remote for the United States. The conference received little coverage in the financial press, but a Reuters wire service story titled "Fed Conference Timing on Inflation Odd but Useful" emphasized the remoteness of the risk. Participants at that conference could not have anticipated that only 10 years later, the world would be engulfed in a deep financial crisis, with unemployment soaring and central banks around the world making extensive use of new strategies, tools, and ways to communicate. The next time policy rates hit the lower bound, and there will be a next time, it will not be a surprise. We are now well aware of the challenges that the ELB presents, and we have the painful experience of the global financial crisis and its aftermath to guide us. Our obligation to the public we serve is to take those measures now that will put us in the best position to deal with our next encounter with the lower bound. And with the economy growing, unemployment low, and inflation low and stable, this is the right time to engage the public broadly on these issues. The review has several parts, all of which are intended to open our monetary policy up to critical examination. We're holding a series of Fed Listens events around the country to help us understand the perspectives of people from diverse backgrounds and with varied interests. This conference and many other engagements will help us bring to bear the best thinking from policymakers and experts. Beginning later this year, the FOMC will devote time at a series of our regular meetings to assess lessons from these events, supported by staff analysis performed throughout the Federal Reserve System. We will publicly report the outcome of our discussions. And in the meantime, anyone who's interested in participating or learning more can find information on the Federal Reserve Board's website. Before turning to the specifics of the review, I want to focus a little more closely on the challenges we face today. For a reference point, at the time of the 1999 conference, the United States was 8 years into an expansion. Core inflation was running 1.4%, and the unemployment rate was 4.1%. Not so different from today. Macroeconomists were puzzling over the flatness of the Phillips curve, the level of the natural rate of unemployment, and a possible acceleration in productivity growth. Questions that are also with us today. The big difference between now and then is that the federal funds rate was 5.2%, which, to underscore the point, put the rate 20 quarter-point rate cuts away from the lower bound. Since then, standard estimates of the longer-run neutral rate of interest have declined between 2 and 3 percentage points, and some argue that the effective decline is even larger. The combination of lower real interest rates and low inflation translates into lower nominal rates and a much higher likelihood that rates will fall to the ELB in a downturn. As the experience of the past decade showed, extended ELB episodes can be associated with painfully high unemployment and slow growth or recession. Economic weakness puts downward pressure on inflation, which can raise real interest rates and reinforce the challenge of supporting needed job growth. In addition, over time, inflation has become much less sensitive to tightness in resource utilization. This insensitivity can be a blessing in avoiding deflation when unemployment is high, but it also means that much greater labor market tightness may ultimately be required to bring inflation back to target in a recovery. Using monetary policy to push sufficiently hard on labor markets to lift inflation could pose risks of destabilizing excesses in financial markets or elsewhere. In short, the proximity of interest rates to the effective lower bound has become the preeminent monetary policy challenge of our time, tainting all manner of issues with ELB risk and imbuing many old challenges with greater significance. For example, the behavior of inflation now draws much sharper focus. When nominal interest rates were 4 or 5%, a low-side surprise of a few tenths on inflation did not raise the specter of the lower bound. But the world has changed. Core inflation is currently running a bit below 2% on a trailing 12-month basis. In this setting, a similar low-side surprise, if it were to persist, would bring us uncomfortably closer to the effective lower bound. My FOMC colleagues and I must, and do, take seriously the risk that inflation shortfalls that persist, even in a robust economy, could precipitate a difficult-to-arrest downward drift in inflation expectations. At the heart of the review is the evaluation of potential changes to our strategy designed to strengthen the credibility of our symmetric 2% inflation objective. The ELB problem also complicates the FOMC's efforts to achieve transparency and accountability. The Fed, like most major central banks, is insulated from short-term political pressures. In our democracy, that insulation carries with it an obligation for us to be transparent and publicly accountable. When policy rates reached the effective lower bound during the crisis, central banks resorted to what were then new, untested tools to pursue their mandated goals. These tools are no longer new, but their efficacy, costs, and risks remain less well understood than the traditional approaches to central banking. My FOMC colleagues and I are committed to explaining why the use of these tools in the wake of the crisis was a prudent and effective approach to pursuing our congressional mandate, and why tools like these are likely to be needed again. Our review is but one part of our efforts to engage with the public on these matters. Let me turn now to the specifics of the review, which is focused on three questions. First, can the Federal Reserve best meet its statutory objectives with its existing monetary policy strategy, or should it consider strategies that aim to reverse past misses of the inflation objective? Second, are the existing monetary policy tools adequate to achieve and maintain maximum employment and stable prices, or should the toolkit be expanded? And third, how can the FOMC's communication of its policy framework and implementation be improved? These questions are quite broad, and my colleagues and I come to them with open minds. We believe that our current policy framework is working well, and we've made no decisions about particular changes. In fact, the review is still in its early stages. The first question raises the issue of whether the FOMC should use makeup strategies in response to ELB risks. By the time of the 1999 conference, research was beginning to show that, in models at least, such strategies could substantially reduce the unemployment and other costs of ELB spells. The simplest version goes like this. Suppose that a spell with interest rates near the effective lower bound leads to a persistent shortfall of inflation relative to the central bank's goal. But what if the central bank promised credibly that it would deliberately make up for any lost inflation by stimulating the economy and temporarily pushing inflation modestly above target? In the models, the prospect of future stimulus promotes anticipatory consumption and investment that could greatly reduce the pain of being at the effective lower bound. Policymakers discussed this reasoning in the wake of the crisis, but neither the Fed nor any other major central bank chose to pursue such a policy. Why? For makeup strategies to work, households and businesses must go out on a limb, so to speak, raising spending in the midst of a downturn. In theory, they would do this based on their confidence that the central bank will deliver the makeup stimulus at some point, perhaps years in the future. This is quite a flattering assumption, and in models, great confidence is achieved by assumption. Despite the flattering nature of the assumption, crisis-era policymakers had major questions about whether their promise of good times to come would really have moved the hearts, minds, and pocketbooks of the public. Part of the problem was that the groundwork had not been laid in advance of the downturn, a problem we could hope to fix well before the next time. Policymakers also had deeper concerns about the legitimacy and effectiveness of attempting to bind some future FOMC to take actions that could be objectionable from a short-term perspective when the time came to deliver. Research on makeup strategies has begun to grapple more seriously with the credibility questions, but important questions remain. To achieve buy-in by households and businesses, a comprehensible, credible, and actionable makeup strategy will need to be followed by years of central bank policy consistent with that strategy. The second question asks about the adequacy of the Fed's toolkit for providing stimulus when facing the lower bound. In the United States, we used several different formulations of both forward guidance and large-scale asset purchases of longer-term securities. While views differ on the effectiveness of these policies, with their use, the unemployment rate fell steadily and inflation expectations remained well anchored, outcomes that were favorable overall when viewed against the recoveries of many other advanced economies. My own view is that these policies provided meaningful support for demand, but that they should not be thought of as a perfect substitute for our traditional interest rate tool. In any case, we have a responsibility to thoroughly evaluate what mix of these tools is likely to work best when the next ELB episode arrives. Perhaps it is time to retire the term unconventional when referring to tools that were used during the crisis. We know that tools like these are likely to be needed in some future form in future ELB spells, which we hope will be rare. We now have a significant body of evidence regarding the effectiveness, costs, and risks of these tools, including those used by the FOMC and others tried elsewhere. Our plans must take advantage of this growing understanding as assessments are refined. The third question concerns improving communication, which I discussed earlier from the standpoint of governance and accountability. But transparency also plays a central role in policy effectiveness through its effects on the expectations of households and businesses. Of course, this was the major insight behind the transparency revolution in central banking over the past few decades. Today, central banks publicly share a large and ever-increasing amount of information about policy, but policymakers and commentators inside and outside central banks sometimes question whether all of the transparency adds up to effective communication. The FOMC's dot plot is one example. A focus on the median forecast amounts to emphasizing what the typical FOMC participant would do if things go as expected. But we've been living in times characterized by large, frequent, and unexpected changes in the underlying structure of the economy. In this environment, the most important policy message may be about how the central bank will respond to the unexpected, rather than what it will do if there are no surprises. Unfortunately, at times the dot plot has distracted attention from the more important topic of how the FOMC will react to unexpected economic developments. In times of high uncertainty, the median dot might best be thought of as the least unlikely outcome. Let me conclude by saying that I look forward to our discussions here and to the ongoing work of the review that lies ahead. We need the best tools and strategies possible for dealing with the challenges we now face, and we must communicate them in a clear and credible way. My colleagues and I welcome your best thinking on these issues. Thank you very much.
Okay. Thank you very much. It's time for the first panel to come up. Thank you, Chair. Okay, come on up. While everybody's coming up, let me introduce the moderator, then he can do the other introductions. Now I'd like to introduce our first moderator, Yuri Gorodnichenko. Dr. Gorodnichenko is a professor in the Department of Economics at the University of California, Berkeley. He's an applied macroeconomist with interest in issues related to transition economies, especially labor markets and firm performance. Dr. Gorodnichenko was named the inaugural Quantedge Presidential Chair in Economics at UC Berkeley in 2018 and serves as a research associate at the National Bureau of Economic Research. He sits on the editorial board at the Review of Economics and Statistics and serves as an editor for the Journal of Monetary Economics. Yuri earned his BA and MA at EERC Kiev Moola Academy and his PhD at the University of Michigan. Please welcome Dr. Gorodnichenko in the first panel.
Thank you for the introduction. I'm very happy to be chairing this very distinguished panel. We're very lucky to have a dream team of authors and a discussant. Jim Stock is a professor at Harvard University. Janice Eberly is the professor at Northwestern University. Jonathan Wright, John Hopkins, and John Taylor from Stanford. Their vidas are very, very long, so I'm not going to read you their achievements. I just want to assure you that we're very, very lucky to have this extremely distinguished panel. The first speaker is going to be Jim Stock. Thank you.
Thank you, Yuri, and President Evans and Chair Powell. Before turning to our paper, let me say just a word about the framework review which Chair Powell described. This framework review is an important step for the Fed in terms of transparency and engagement with the public about how it accomplishes its mission. By asking what we have learned over this recovery and seeking external input into this review, the Fed is demonstrating best practices for responsible policymaking by an independent agency. I and my co-authors, Jan Eberly and Jonathan Wright, are honored to be part of this review. This morning, I am going to summarize the Fed's current framework for monetary policy, review how it has performed over the current recovery, and offer some thoughts about its strengths and how it might be refined. As Chair Powell explained, the Fed's current long-run monetary policy framework starts with the Humphrey-Hawkins Act of 1978, which instructs